If you earn over $250,000 or more and have $1 million in a taxable brokerage account, then today's discussion on a unique investment strategy is one you will not want to miss. Even if you don't meet these criteria, you'll still gain valuable insight to this strategy. I'm Hunter Kelly, certified financial planner, and this is Retire Early, Retire Now. New episodes drop every Tuesday morning, and they're designed to help high-income earners maximize their wealth. If you're watching this video on YouTube, go ahead and subscribe to my channel and like the video. And if you're listening on your favorite podcasting app, please leave a 5-star review. So what strategy are we talking about today? This strategy has been available to the ultra wealthy for many, many years. Generally, the minimums for this type of strategy would be $20+ million. But given the advent of new technology, trading systems, zero trading fees, things of that nature, it has become a little bit more widely available. And that's what we call direct index investing. And so you may have heard this before. And direct indexing on it in itself or by itself is a good way to invest for a number of reasons. But when you overlay it with some of the tax strategies that we'll talk about today, it can really help you boost your wealth over a long period of time. And so what we'll learn today is, one, what is this investment strategy? How does it work? Two, what are the benefits that you can achieve from this strategy? And then three, what are the criteria that make it a good strategy for you? And so listen to today's podcast, and we'll learn a little bit more about investing and hopefully help you out in the long term and gain a little bit more wealth. So what is this strategy? What is it trying to achieve? So in your brokerage account, obviously these investments are going to be taxed a little bit different than how your investments would be taxed in an IRA, a Roth IRA, or 401k, where all those taxes are generally deferred or potentially tax-free once you take those distributions, depending on the type of account. But in these brokerage accounts, there's a number of ways that you can be taxed, whether that be through capital gains, dividends, things of that nature. And so we want to make sure that we're investing in a way that will minimize these taxes, because taxes will be the biggest drag on your return as you start to build wealth and gain wealth through this account. And so generally speaking, there's a number of different investments. There's mutual funds, ETFs, stocks, bonds, or the most common, right? And so as you talk about tax efficiency, working from least efficient to most efficient, mutual funds are going to be the least efficient. They don't trade intraday. You have to calculate something called the net asset value at the end of the day, called the NAV. And the way they do distributions of capital gains and things of that nature, they're just not as tax efficient. And so the next layer to that came the advent of ETFs. These are much like mutual funds. They're more passive though, and they do trade throughout the day. So they're a little bit more tax efficient. But if you want to have the most tax efficiency or the most tax flexibility in your brokerage account, single holdings like stocks and bonds make most sense. But with that level of more tax flexibility or tax efficiency comes more complexity. So you have to be careful. So if you're unsure on how to pick stocks or how to buy them or how you should be evaluating them, certainly seek a professional to do that. And that's something that we do here at Palm Valley Wealth Management. But so from there, you can kind of determine, okay, well, how efficient am I? Do I have mutual funds? Do I have ETFs? What's the best way to unwind these and make my brokerage account more efficient, things of that nature? And then what you're really trying to achieve with the strategy that we're talking about today, direct index investing, which we'll define here in just a second, is we want to try to add tax alpha. So what is tax alpha? Tax alpha is just a fancy word of saying, hey, we want to minimize as much tax liability off of this account and keep that money invested. And so how does that work in practice? In theory, that sounds great, right? And so Dimensional Advisors ran a study and said, if you utilize direct index investing plus some of these tax efficiency strategies, then you could add up to 1.5 to 1.85% each year on your brokerage accounts, right? And so if you add that and you compound that year over year, that can be a mass difference of account values over a 10-year period, 15-year period, 20-year period. And so in practice, this can actually work, but there's a lot of systems that have to be in place, a lot of due diligence, and a lot of tracking. So there's, like I said, as you move to more of these more complex or more tax efficient portfolios, there becomes more complexity and things that you have to watch out for that we'll talk about here in just a little bit. And so one way that we track it at Palm Valley Wealth Management is we actually have what we call a tax save report. So at any moment, we can jump into our clients' portfolios, run what we call a tax save report, and we can see, okay, well, how many losses have we captured to save on taxes and things of that nature. And so how much are we actually keeping in the pockets of our clients so that we can keep that money invested and help their wealth grow more over time, right? And so back to the original strategy. What is direct index investing, right? So we've talked about kind of the efficiencies and what we need to achieve in these brokerage accounts, but what is the strategy that we're actually talking about? So let's compare the S&P 500. Most people know what the S&P 500 is. The vast majority of my clients, especially when I first meet them, they always want to compare their investments. How am I tracking against the S&P 500? Whether they own similar stocks or holdings or not, they always just want to track against that S&P 500. So the S&P is the largest 500 companies in America, and it is what they call cap weighted, right? So if it's a larger company, they're going to have more of that particular index. And so generally, most people buy this through index mutual funds or through an ETF where they can just buy that particular holding, and then you would own those stocks through that ETF. But if you go to sell those ETFs, you would sell basically the whole entire index, right? And so the difference between that and what direct index investing is the fact that you buy each individual component of that index. So instead of going to buy something like VOO and having the index in one share, you're going to buy Apple, you're going to buy Amazon, you're going to buy Google and the rest of the 500 companies inside of that index. And so this is going to give you a couple of things. One, it'll give you more tax flexibility, and we'll talk about how that works in just a second. It'll give you more customization. So if there's certain stocks that you don't want to own, so if you don't want to own stocks that deal with war or tobacco or for religious reasons, whatever that may be, you can leave those out, right? Or let's say you have a very concentrated holding because you work for a big tech company. Well, maybe you don't want Apple or Google or NVIDIA in your portfolio. NVIDIA is probably the most recent big news stock that has gone on the last year, big run. So maybe you have a large holding because you work at NVIDIA and it's 30, 40, 50, 60, 80% of your net worth. Well, if I go to buy this index directly, like we're talking about, well, I can leave out NVIDIA and start to build a portfolio around it, right? And so the customization is the one great perk, but where we start to see better returns and can really gain wealth over the long term is using things like tax loss harvesting. So if you take a year like 2022, the market's down 25-ish%, where all of these stocks essentially were down, and the S&P is down 22%. Well, you would be able to, if you started out at the beginning of 2022, you put $1 million into a brokerage account, you bought the index directly through the single holdings, you may have been able to capture up to $250,000 worth of losses. And then you can use those losses to offset gains elsewhere, whether that be in other holdings later on down the road, because you can carry these forward, right? So if I have $250,000 of losses, then I can carry those forward to a future year. So if I hold on to those losses, I don't use them, let's say for 5 years, I'm ready to sell for whatever number of reasons. In my portfolio, if I say I need $100,000 to go buy a house or help my kids with college, whatever the case may be, well, then I can sell that, and then I can use the $250,000 worth of losses to offset maybe $20,000 of gains or $50,000 of gain, right? If I don't use all of them, I can continue to carry those losses forward until they're gone. The other thing is you may be thinking, okay, well, 2022, yes, it was a down year. Everything was down, right? Well, think about last year. Last year, the S&P was up about 26%, and if you own the ETF that tracks the S&P, well, then you would have almost no opportunity to capture any loss. But if you held these single holdings to mimic the S&P, about 34% of those stocks were down. So then that gives you opportunities to sell those stocks to capture losses and get back in after 31 days to avoid wash sell rules, right? And so this is where the direct indexing strategy really becomes fruitful, is that even though your portfolio as a whole may be up, you're still going to have some really good winners and some stocks that just aren't doing well that year. And so that will give you opportunity to tax loss harvest and be able to minimize taxes along the way. And let's say you're able to accumulate hundreds of thousands of dollars of losses and you own a company and you're going to sell that company to retire, or just it's a good time to sell, whatever the case may be. You can actually use these losses to offset those gains that you have in that individual company, right? So if you own a company, let's say it's worth $3 million and your cost basis is essentially zero. Well, if you've racked up $500,000 worth of losses, $1 million worth of losses, you can use those losses to offset those gains for that sale of that business and save quite a bit in taxes moving forward, right? And so this is a great strategy, not only to help you within your brokerage account, but maybe some other satellite investments that you have, whether that's owning a business or a different brokerage account elsewhere, wherever that may be, right? And so harvesting those losses can be a great tool. Now, you have to be careful with harvesting losses. You don't want to just harvest losses to harvest losses, right? You don't want to just sell low because you have a loss and capture that loss and have no plan with the funds afterwards, because then you're just locking in that loss and you're not necessarily doing anything with it. You want to have a plan to either buy back after the wash sale rule ends after that 31-day period, or have a similar stock that performs similar but is materially different so that you can get that money back into some sort of investment and hopefully continue to work for you long term, right? And so we want to be careful about how we're doing these strategies, just because there is nuance there, right? We just don't want to sell low and keep cash and stay there forever. We want to have a plan how to move forward. We want to make sure that we get these losses on paper, but we're right back in the market so that we can keep our money working for us. So what does it actually take to manage a type of portfolio like this, where we're picking, let's say, the S&P 500, and S&P is just an example. You don't have to just use the S&P 500. You can do this with small companies, mid-sized companies, international companies. Obviously, there's nuance there, but you can follow other indexes where now you can build a well-diversified portfolio. You can have potentially thousands of holdings. So now we're getting the customization, we're getting the diversification, we're able to capture losses, we're adding that tax alpha that I talked about earlier. But again, with that comes more complexity, right? So what does it take to manage this type of portfolio? Well, you need a robust daily trading system. Mainly, if you're adding more than just ETFs and you're adding these single holdings, and you're not necessarily doing this tax loss harvesting or some sort of offset where you're trying to compensate for maybe your outside holding through a company where you have stock like Nvidia or whatever, you want to make sure that you're not just buying these single holdings to buy these single holdings, because you're making your situation just more complex for no reason, right? You want to have a plan for this portfolio, and the way to do that is to have a daily trading system. So if you have if you add more indexes outside of the S&P, looking at reviewing over 500 stocks per day, that can be time consuming. You probably don't want to sit in the computer all day while the market's open trying to figure out, should I capture losses, should I not? And that's just the S&P, right? If you have the Russell 2000 or any other indices, you would have quite a bit of holdings to look for losses, and you have different, what we call different tax lots. So even though you own Google, maybe some Google shares are at a loss, but some are at a gain. So which ones do I share? And so having that trading system in place can help minimize that work, right? And then on top of that, you need that trading system to have high tax sensitivity, because you don't want to get caught with selling something and buying it back too early, because then you're hitting what's called the wash sell rule, right? And you're going to potentially negate those losses that you thought you had on paper. So you want to have a system that has high tax sensitivity, right? And so that requires a sophisticated trading software, right? And so having a great custodian to do that, again, that's something that we do here at Palm Valley Wealth Management. And I would say the vast majority of just retail investors, most are not going to be able to do that, right? Because just reviewing the number of holdings alone would take a lot of time. So if this is something that interests you, and after we talk about the criteria, if it's a good fit, go find someone to help you do this, because I think it would outweigh whatever cost it would be, because you would end up receiving that tax alpha, maybe some more customization for your portfolio, whatever that may be. And so the value may outweigh whatever that cost may be, right? And so again, historically, this has been for the ultra wealthy, but with the advent of zero trading fees, being able to buy partial shares, better technology, things of that nature, direct index investing is becoming more widely available. So if you have $500,000, $750,000 that you're ready to invest, this could be a good situation for you, a good strategy for you. And then the 5 things or 4 things where I think it could be a no-brainer for you is if you're in those higher tax brackets. If you're making $250,000 or more a year, you're hitting that 24% tax bracket, working up to the 37% tax bracket, and you're in that upper capital gains where you're paying 20%, this should be a no-brainer. The higher the tax bracket you have, the more fruitful some of these strategies will be for you. If you have gains elsewhere, right, then this would be a great strategy for you, because you can start capturing losses and be able to offset particular gains elsewhere. And I talked about owning an outside business, right? If you own a private business and you go to sell that business and you're accumulating losses within inside of these accounts, well, then now you can offset those gains. Or maybe you have a portfolio and you're trying to unwind that portfolio to get to something like this. Well, as you start accumulating assets into this account, whether it's through dollar cost averaging, through your cash flow date each month and things of that nature, you can start to capture losses and maybe unwind those ETFs and things of that nature to get into this type of portfolio to be a little bit more optimal from a tax standpoint long term. If you have concentrated stocks, so again, if you work at NVIDIA or Google or any number of these publicly traded companies, and a large portion of your compensation has come from stock, and that stock has done well, this can be a great strategy for you, because again, if your stock is traded on the S&P 500 index, and you don't want to own that index, well, if you go buy the ETF, you have no choice. You can't tell that manager, hey, I don't want Google, or I don't want Paylocity, or whatever index we're talking about, right? You can do that if you go and you buy the index directly through single holdings, right? And so now I don't have to have Google in my portfolio. And then as this direct index investing strategy becomes a larger portion of my portfolio, then I can start to unwind or potentially buy some Google if it's something that I want to do. The next thing would be charitable giving. If you're charitably inclined, giving appreciated stock can be much more fruitful for one, the charity that you're giving to, and then 2, for your deduction, right? If you have a stock that's worth $10,000, but you paid $5,000 for it, and you sell it to go give to a charity, well, you're going to pay capital gains on that $5,000, right? That you earn through interest or growth. And so if you just go ahead and gift that to the charity, well, now you get to gift the entire $10,000 and you get a bigger write-off. And so there's some limits and nuance to that. So if you're into charitable giving, make sure you seek a tax advisor, financial advisor, to make sure that you understand those rules and everything. But those four criteria, if you're meeting those, you're like, hey, that's a great strategy. I think I should start looking into that. Meet with a financial advisor, start researching financial advisors, because again, direct index investing can allow you to gain up to 0.5% to 1.85% a year through these things like tax loss harvesting, making sure that we're not getting over concentrated in other stocks that we have at either our company or whatever the case may be, right? And so being in a higher tax bracket, maybe having gains elsewhere, concentrated stock and charitable giving, if you meet those criteria, this should be a no-brainer for you, right? To end this, direct index investing can be a great strategy for you. Obviously, it adds a lot of complexity. If you're confused, if you're like, hey, I meet these criteria, but I just don't understand how to do those sort of things, reach out to us, me at palmvalleywm.com. We'd love to have a conversation with you on how this could help you and help you grow more wealth over time. So hope you enjoyed this podcast. Go ahead, again, share this with a friend, like the video on YouTube, and leave a 5-star review on your favorite podcasting app, and we'll see you in the next one. This podcast is for educational purposes only. It is not meant to be financial, legal, or tax advice. Please seek a professional about your specific situation. Keep Palm Valley Wealth Management in mind when making those considerations.